Hello and welcome to Moneycontrol. You have tuned to IPO Watch and I'm your host Nickey Mirchandani. Today we are here to talk about Entero Healthcare Solutions. An IPO, which is the company rather, is looking to raise around 1,600 crore. The issue has been divided into two parts, 1,000 odd crore, which is coming in from the fresh issue, and 600 crore, which is an OFS. Of course, the 1,000 odd crore is largely to meet the working capital requirements of the company. A bit background about the company before we speak to the management. Entero is a pan-India wholesale distributor of healthcare products from the manufacturer to the retail pharmacies and hospitals. It also offers promotion services and provides technology solution to its customer to help with order management, inventory management, amongst other things. But to know more about the company financial strategy outlook, we're being joined by Prabhat Agarwal, who is the promoter, managing director of the company. Hello there, how are you doing?
Good, very excited to be part of this show.
All right, pleasure is all ours. I'm going to say that, it is a very differential offering that we're looking at. What's your growth strategy? The company has acquired in number of entities. What's your growth plan going forward?
So if you look at our historical, we are a relatively young company. We started out in 2018 and in 5 years time frame, we could become one of the largest distributors in the country, right? And, today if we count our customer base, 81,500 retail pharmacies, 3,400 plus hospitals, so almost 1 out of 10 pharmacies buying from us in India, right? So that shows a massive confidence and trust in our business model. We are working with close to 1900 plus healthcare product manufacturers, right? We have the biggest product range available from all companies put together, and we are distributing to such a large customer base using 77 warehouses, spread across the country. And all this has been achieved in a very relatively short period of time of 5 years. Last 3 years, our annualized growth rate has been 36% CAGR, right? So it's we have been in a very high growth phase, and with this next capital raise that we are doing in this IPO, we will be even more bullish about the future, opportunity and our penetration in rest of the country.
Sure. The money that you're raising in is essentially to meet your working capital requirements. We are going to dwell on to the working capital requirements and other financials in just a bit. But first, let's concentrate on your plans. Are you planning to scale up more organically or inorganically going forward? Because there were 3 entities that you acquired in 2023, 8 in 2022 and 3 again in 2021. So what's your growth plan looking ahead like?
So inorganic growth, acquisition of small regional distributors is part of our overall growth strategy and the way to penetrate a very different and vast Indian geographic market, right? So many new markets that we enter through acquiring a small local distributor, right? And then we scale up that distributor significantly, and our strategy in future is not going to be different than what it has been in the past. So we will use a both mix of organic and inorganic growth strategy. If you look at last 3 years, our growth rate has been 36% year on year, out of which 22% is organic growth and 14% is inorganic growth, right? So going forward, we will use both a mix of organic and inorganic to vastly expand our presence in India.
22% inorganic and 14% you said was organic.
No, other way around. 22% was organic.
Organic and okay, so 14% was inorganic. Do you intend to continue with that mix?
Mix could change a bit because, with more capital coming in now, we might be more aggressive on organic growth, right? So the mix could change. At the end of the day, inorganic is just a means to an end, right? Our end vision is to create a pan-India distribution organization which can give vast access to Indian healthcare market, right? To every brand that works with us or every company that works with us, right? So to reach that end, we use both organic, opening our own warehouses, opening our own branches, or we can acquire a small distributor in rest of the parts, right? So both strategy we use to achieve the same end, which is having a pan-India presence.
Okay. So any segment per se, any company that you've identified, any geography where you'd like to expand inorganically, anything in the near term that we can look at, any kind of, how do you intend to fund that kind of inorganic expansion? What's your plan?
Yeah, so we have identified, many such opportunities. We have mentioned some of them in the document as well, right? And post capital raise, we would be going aggressively after that.
Why don't you talk about it?
I'm constrained by, giving forward-looking statements, but as I mentioned,
It's
growing
also there as
inorganically.
your offer document, like you pointed out. So it's not
we have
new
mentioned,
information.
we have signed 17 term sheets to acquire more distributors in the country.
And those are how many distributors in that case?
17 term.
17.
Yeah,
Okay, 17 term sheets. Fair. And that is expected to term out by when approximately?
I mean, we will pursue that immediately once we raise money, right? So we will do our best to consume them as soon as possible.
Okay, and how much incremental growth can that contribute towards your top line performance in that case, if you're supposed to look at that?
Yeah, I mean, forward looking statement is a difficult number to give for us, but you look at, last 3 years we have grown 36%, right? With additional firepower in terms of additional capital that we are raising right now, we would definitely be, super aggressive for the future growth.
Okay, all right. Also, the company has experienced in some negative cash flows from the operation for all the 3 years and also 6 months ended. The number that I see is almost for the first 6 months is 827 odd crore. How do you intend to mitigate that and perhaps be a little more?
Negative, cash flow is a result of very aggressive growth, right? So we have pursued, in last 5 years, we have set up a very strong foundation in this country, right? We have a massive presence right now, and that has come at a cost of, investing for our growth, right? So as the business matures, as the margins improve, the working capital or the operating cash flows will turn positive.
Okay. Also, let's tell about how different is your company versus the companies that operate in your industry. Tell us more about the industry growth. Tell us how much can you outperform that growth. Give us some details around that.
So the industry, the target addressable industry for us is 2.7 lakh crore market, $33 billion, right? And that market itself is growing 10-11% year on year. So it's a large market, at the same time growing market, right? Every year we are adding like 25 to 30,000 crores of market itself, right? And this market is extremely fragmented. We have 65,000 distributors operating very regionally and locally, right? We have a massive right to win in terms of, our technology, our product range, our, manufacturer relationships, our scale of business, our ability to access capital. So there are many differentiators that we have in our business, which gives us the possibility to, to grow faster than the market.
Okay. So any one particular trade that you think would be the cutting edge for you?
Our scale. Number one, everything comes from scale. The scale gives you the ability to invest in infrastructure. Scale gives you the ability to invest in talent, hiring good people, deploying technology, right? So attracting good customers, good companies to work with. So scale is a big differentiator, and the second is technology. These two combined together makes any supply chain business a successful business.
Okay, the company has also kept an asset-light model wherein majority investment is in the form of working capital needed for sourcing pharma supplies. Do you intend to change that anytime soon, or that's the preferred model that is margin accretive in nature?
Will always remain an asset-light model because we don't need a lot of fixed assets. All the warehouses that we operate from are leased warehouses, right? We take it on and we don't want to buy them because we are growing so well. That every few years we might need to change the warehouse. Our capacity expansion, our growth can outpace the capacity, right? So we don't want to lock ourselves into a fixed asset. We want to continuously grow, expand, right? So going forward also, our capex needs are not supposed to be significant.
Okay. Let's talk about your working capital in that case, because that's also one area of concern that we've been looking at. Of course, the fundraising also is coming to tide away with the requirements for your working capital. How insulated is the company in the future vis-a-vis for your working capital requirements? Do you intend to, for your future needs, to tap the market to fund the aggressive plans that you're looking at? What's your perspective out there?
No, so future growth, as we expand our customer base, we expand into new geographies, we increase our wallet share with our customers. That will require working capital, right? Because we'll need to hold inventory, we'll need to invest in receivables, right? We also get some credit from the companies as well, but our working capital needs are going up, right? As the growth goes up, as the sales grows up, right? And that's the reason why 50% of our IPO proceeds are earmarked for that, right? And that should be good enough. As of now, our working capital days are between 60 to 65 days. So we turn our working capital 6 times during the year. We intend to even improve it going forward as well. But that's where this business is driven by working capital.
How much do you expect to improve it by the end of this financial year?
There's no specific quantifiable target right now that I can give, but definitely as the scale grows up, as business grows up, we enjoy better terms with our suppliers. We optimize our inventory using technology. So all this will end up, or result in our working capital ratio improving further.
Okay, any particular ballpark that we could work with, that the company rather is going to be comfortable with?
No, we are aggressively chasing every bit of optimization in the business,
And that's precisely that question. Given the aggressive expansion plans, what is the number that is going to be at the comfort level for the company?
I mean, as I mentioned that, we have identified and signed term sheets with 17 distributors in the country, right? So, and we have a good, 8-10 people on ground who is continuously working on identifying new markets, new distributors that we could partner with, right? So that will continue to happen, and that's an important element of our growth strategy.
Okay, so no comfort ratio that you're looking at?
Comfort, I mean, I can only tell you that, we could grow 36% year on year in last 3 years, based on whatever limited capital we had, and then we were disrupted by COVID also, and for 1 or 2 years, and we invested a lot in building up the team, building up the infrastructure, building up the scale, building up the customer relationships, building up the company relationships. All this will bear fruit in times to come.
Okay. All right, a bit of revenue CAGR, let's talk about that. You've spoken also about 36% growth, which the company has even clocked in on a CAGR, compounded annual growth rate basis for FY21 to 23, of course. Do you expect to outperform that number anytime soon? If yes, what will be the growth drivers going forward?
We will, of course, endeavor to outperform ourselves only, right? So, in terms of growth drivers, as I mentioned, geographic expansion, penetration in more parts of the country, using both organic and inorganic route, expanding our wallet share with our customer base, growing our customer base, right? Pursuing more strategic collaborations with the companies, right? Using more technology to drive business, right? So these are all the, levers available to a large player like us to expand very well in this fragmented market. This extreme fragmentation gives us a unique opportunity to outperform.
Okay. Also, let's talk about your margin. The gross margin of the company has remained at 8%, but the EBITDA margin has been around that 1 to 2% over the last 3 years or so. What can be expected going forward?
So in the first 6 months of the year, our gross margins have also expanded. It's now closing close to 9%, right? Our EBITDA margins have also improved to 3% now, right? And, now we have seen, a good amount of scale through which we can drive more efficiencies, more operating leverage as we grow. Our cost base is not going to increase in the same proportion in which our revenues are increasing, right? And contribution from private label, more value added services. Our buying power gives more margin possibilities for us, right? So all these levers will play out, in times to come to further expand our margins.
How about your debt?
Debt, we have like 350 to 400 crores of net debt, part of which we are retiring using IPO proceeds, and part of the debt we'll retain because working capital we get good financing from all the banks, and that gives us a cheaper source of capital.
So what is the post-listing debt to equity ratio looking like and debt levels looking like, and do you intend to continue and sustain around those levels?
Yeah, I mean, post this capital raise, our equity capital itself will be more than 1600 crores as compared to like 200-300 crores of debt, right? So, our equity will be like 7-8 times of debt, right?
Okay. So are you comfortable around that level, or you are looking to further bring it down?
We are comfortable. I mean, we will use a mix of both debt and equity to, pursue growth.
So this growth will be more in the favor tilted towards the debt part of it or equity side of it?
A large part of this equity that we are raising is going to be deployed for working capital, which we could have, used debt to finance working capital. But, we want permanent working capital in the company, and that's what we are raising equity for.
No, I understand the present. I'm just saying that going forward in the future, how is the debt and equity ratio is going to be
Equity
tilted?
always will be more than the debt, for sure.
Okay, so 60-40 is what one can look at?
It could be even lower.
Okay, so 70-30 perhaps is what we can look at.
I mean, it's difficult to quantify a number, but as I told you, our equity capital is going to be far more than the debt.
Okay. The company has also been posting losses on the bottom line front for the past several years, limited history, 3 years at least the losses. It's shown a turnaround for the 6 months ended September 30. But what are the growth drivers ahead on sustainable basis? What is the bottom line growth one can work with?
Yeah, so as you know, our revenue grows up significantly, through our growth strategy that I mentioned before, and our operating leverage kicking in, our gross margins improving because of our buying power and contribution from private label. The impact on margins is supposed to be higher than the impact on revenues, right? Because our costs are not likely to grow in the same proportion as revenue.
Okay, all right. So profitability going forward, what is a scalable number that one can look at?
I mean, difficult to give a specific number on profitability, right? But I can tell you, we are working, all of us, and all the strategies are deployed towards, improving margins.
Yeah, the reason why I am repeatedly asking this is because the company has been loss-making for the last 3 years, and the turnaround that has been seen is only seen in the first 6 months. So some sense of direction, if not for numbers, that you can provide to our viewers.
First of all, I would like to tell your viewers that for last 3 years, operationally we have been profitable. If you look at our EBITDA numbers for FY21, it was 50 crores plus. FY22 also 50 crores plus. In FY23, which is the last financial year, we did an EBITDA of 85 crores. In this 6 months of the year, we have already done 61 crores, right? So operating profit wise, we have been profitable.
You'll be able to outperform the 85 crore number that you've clocked in FY23 because you've already done 61 crore as of 9 months ended, right?
6 months.
Okay, 6 months ended.
Yes.
So almost if one was supposed to analyze, we're looking at 120 odd crore growth coming in.
If you analyze that, yeah.
Yeah, so that's the FY24 number. So based on that, what can be the profits that one can look at, and would you sustain that kind of trajectory, if I may ask?
Yeah, of course, we have already seen in last 2 years profitability going up, right? So with more growth, with more expansion in our business, with more scalability, with more contribution of private label, value-added services, operating leverage, this is only going to grow up, right?
All right, so we'll leave it at that, and thank you so much for taking out the time and having this conversation.
Thank you. Thank you so much.
All right, with this, it's a wrap. Entero Healthcare Solution is coming up with an IPO. Day 1 of bidding intends to bring down the debt. Also, the working capital requirement needs will be taken care of with this initial public offering. Looking at profitable growth, but with this, it's a wrap, and goodbye from the entire team who puts this piece together for you. Thank you so much for watching.